All right, so Wall Street fixated on inflation and the impact, obviously, from the Iran conflict. But I think West Texas Intermediate may have peaked here. We just showed a chart of ExxonMobil a minute ago. Moreover, Bank of America, they posted a chart I think that's important for folks to read and understand. CPI and GPI, the impacts, if you look at the 60s for both, really just a lot less than they used to be in the past. I'm going to bring in out HB Wealth, their chief market strategist, Gina Martin-Adams, along with Edward Jones, head of investment strategy, Mona Mahajan. And ladies, thanks for joining me. You both wrote great pieces here recently, and so I'm glad we're working as a team right now.
Yeah.
Let me start with you, Gina, because you seem to be a little bit more concerned on the inflation front.
I am, and not necessarily just because of the war. We've been talking about inflation as a critical issue that we want to manage in portfolios all the way back to the end of last year. When I started with HB Wealth, we've been talking about adjusting our inflation expectations, thinking about managing an era in which supply chain constraints are somewhat permanent and supply shocks are somewhat permanent. This is just another in a series of supply shocks that have hampered some companies' performance in the index. It's creating a mix shift inside the index, inside the U.S. equity market index at large, and it's creating challenges to asset allocation strategy and portfolio management. Doesn't necessarily mean we think we have a $100 barrel of oil into perpetuity. That's today's current challenge that we've got to contend with. But it does mean that we need to keep a much closer eye on company margins. We need to really understand what an environment in which supply-based inflation pressure is somewhat more persistent looks like and manage to that.
No, Mona, to that point, though, it's been amazing since COVID how well American companies have adjusted. I mean, you tip your hat to them. These folks make a lot of money, and this is one of the areas where I think they earn it.
Absolutely. And look, we're looking at an earnings growth picture for 2026, up 17% year on year. That's after a double-digit year last year. To your point, companies have managed their margins well, they've managed cost pressures well, and now they're managing to the consumer that is facing challenges from higher prices. In fact, inflation has been above the Fed's target for 5 years now. But that being said, if you look at the CPI basket, it is 2/3 driven by services inflation. We're a services economy, and that is starting to show signs of at least some moderation. Now, of course, oil prices will hit the headline, but we think that could fade over time, bringing some relief to that consumer and supporting that earnings growth picture.
All right, let's stay with earnings for a moment. Goldman Sachs out today, Mona. I'll start with you on this because it looked like a good number. I think maybe FIC was a little bit lower, but everything else seemed to come in. At one point, it was the worst performing stock on the S&P 500. I'm not sure where it is right now. I'm a little concerned about these banks. I've been talking about private credit for a while. And it's something doesn't seem right to me with banks. Should I be as concerned as I am?
I think the issue with private credit has been in the headlines a lot. When we do the analysis, we're not seeing any concerns that would lead us to believe that there is a fundamental shift in the private credit or public credit market. So we don't think this is a systemic risk bubbling up underneath the surface like we saw back in 2008. Now, to Goldman's picture this morning, it did seem like FIC was light. Keep in mind that MOVE index or interest rate volatility was also quite light, especially before the crisis. So that could be part of it. We'll see what the rest of the banks say later this week. Look, financials have had a great run through the end of 2025. They've taken a breather now. In fact, I'm more inclined to revisit them as we think about the potential for IPO, M&A activity to pick up, and perhaps the consumer facing a better environment 3 years.
They're going to make a fortune. There's no doubt about that. How are you feeling about that? And also, let me just add to it. We were talking earlier in the show with Bob, the earnings estimates moving higher. A lot of that's technology.
Yes.
It's just really amazing because this was the year the technology was going to hand the baton off to the 493, let them do the heavy lifting.
Yeah.
But once again, we see on the screen there, tech earnings estimates are going through the roof, but so are emerging markets as well.
Yeah, I think financials are very closely tied to the consumer, not as levered to the areas of stronger growth in the U.S. economy. I mean, if you think about the last 5 years, we've been contending with somewhat more steady inflation pressures. We've also had very slow economic growth in contrast to very rapid earnings growth. And that's because technology has driven a greater and greater share of earnings as it becomes a greater and greater share of the market cap of the index, while the economy is more dependent upon the consumer. Financials also are somewhat dependent upon the consumer. And I'm not as optimistic that the consumer will bounce right out of this. I think that we do have slower wage growth. We've got slowing economic growth. We may have just persistently slower GDP growth because the consumer is somewhat steady. Not necessarily weak, but steady and weaker than the business investment components of the economy, which are very robust. So our preference has generally been to really think about the sustainability of those investment trends and what those do to power earnings growth and power opportunities in the index. And I think we want to continue to shift that way. The one thing we haven't really talked about with respect to the financials is the Fed. I think this was the big game changer coming into this year. Everybody was expecting not only acceleration in growth, but also reduction in interest rates. The Fed's on hold now. So if we want to get more optimistic about the financials, I think we probably wait for a recovery consumer, but the Fed especially.
Sounds like a second half maybe story. Let's talk about, speaking of recovery, I saw in the Edward Jones weekly wrap, the term I hadn't seen in a while, the V-shape. The V-shape in stock market. I mean, dare we say that maybe we're at the beginning of a V-shaped bounce in the market, Mona?
Yeah, you know, it is interesting. Look, we've seen over the last several downturns, whether it was the COVID pandemic, whether it was a tariff tantrum, markets have gone through V-shaped recoveries. And certainly that's because markets have gotten savvy. They're forward-looking. So they're going to price in what they see the environment as 6 to 12 months from now. And of course, we have a little bit of a sense what markets are thinking. We see the oil futures curve, in fact, pointing to WTI back at 75 by year end. We see what the markets are forecasting for earnings growth, a nice double-digit bounce in earnings. And we see that, you know, markets are not pricing a recession or downturn of any sort on the horizon. In fact, Fed GDP now is looking at 1.3% for this quarter. Perhaps, as you noted, as we head to year end, we could see a little bit of recovery in that as well. So a good environment, markets are forward looking. We wouldn't be surprised to see a little bit more of that V come to fruition.
Just 30 seconds left. Are you on the V train? Is it too early?
I think you've got a V market without a V economy, right? I think that is the story that has persisted for the last 5 years. As long as liquidity remains ample and as long as growth is still driven by investment trends, that tends to feed through in a positive way to equities.
Gina, Mona, thank you both very much.
Thank you.
Really appreciate it. Thanks a lot.